My name is Yevgeny Sukenko, and I'm an outsourced accounting and advisory services supervisor at Gelman, Rosenberg Freedman, and I will be today's moderator. I'd like to start off today with a few housekeeping items and explain what participants need to do to earn CPE credit for today's webinar. For the best sound quality, we highly recommend you connect by phone instead of your computer. If you have any technical questions or issues during the webinar, please use the questions function to speak with a webinar administrator for assistance. Please note that this webinar will be recorded and made available on our website following the event. The slides will also be posted at the address shown, which is grfcpa.com/webinars. Webinar participants seeking CPE credit for this presentation must complete and submit a short evaluation survey that will appear automatically immediately following the webinar. Please write down the CPE words when they are given, as they will not be provided again. You will be asked to recall these words in order to receive credit. If you have an active pop-up blocker, please take a moment and disable it now so that will not block the survey. Any technical questions about the survey may be addressed to Dominic Acosta at dacosta@grfcpa.com. As the title of our webinar implies, today's learning objective is to provide attendees with a better understanding of how to develop DCAA-compliant indirect rates. 1.5 CPE credits are available to attendees of today's webinar. With all that said, welcome to today's webinar, part 1 of 5, Developing DCAA-Compliant Indirect Rates. Today's speakers will be Paul Calabrese, who is a principal with Gelman, Rosenberg Freedman's Outsourced Accounting and Advisory Services Group. Mr. Calabrese brings a successful track record of working with both nonprofits and government contractors. His remarkable career includes positions with the Air Force Audit Agency, DCAA, and 3 government contractors, in addition to his 20 years plus in public accounting. Chris Brown is the president of Aldebaran and has 25 years of experience with the development and promotion of the SIMPAC software product lines. He has personally helped hundreds of government contractors achieve compliance through the use of cost accounting software that is purpose-built for the government contractor industry. With all that being said, I'm going to turn the presentation over to Paul, who will get us started.
Thanks, Jeff. Okay, well, it's lunchtime for some of us on the East Coast, or for others, maybe good morning to you. Chris, just say hello.
Hello, everybody. I'm joining the crew here at the offices of Gelman, Rosenberg Freedman, coming to you from downtown Bethesda, Maryland, here on the East Coast. So good afternoon to those of you in the Eastern Time Zone, and good morning to those of you joining us from as far away as Alaska.
All right. So you can see some of our sources there. Pretty much today, our sources really are the DCAA ICE template, which you can find at www.dcaa.mil. And we're fortunate that we have some professional job cost software output reports for Fringe, overhead, and G&A that are part of this from SIMPAC SQL. So let's go over pretty much today what we're going to talk about. This first part 1 of 5, is really focusing on what are the types, the format, the structure, how indirect rates for government contractors really work, both in application, and of course you'll want at some point to project them as well as have historical rates. So we're going to introduce a single burden rate, which is a little bit different, a single overhead that A&Es generally use. We'll go through the multi-tiered indirect rates, and you'll see we'll start with service centers, and then we'll go into overhead and G&A, and then we'll talk about the uniqueness of bid and proposal cost. What does the FAR say about these rates? The order of allocations, which is very important when you have more than one and you have some service centers, and just a basic analysis of those indirect rates.
And with that, we've reached our first polling question, which is my level of understanding regarding FAR Part 31, CAS, OMB Circulars, and special contract requirements is A, excellent, B, good, C, fair, and D, in need of improvement? Please take a moment now to answer. While everybody is recording their answers, I'll also provide the first CPE word. The first CPE word is apple, all lowercase, APPLE. Remember, if you want to receive CPE credit, please jot down these words now so that you can use them later when the survey ends. Again, the first CPE word is apple.
Based on the responses from the poll that we just launched, I think we should kind of take a step back and kind of define some terminology here. So we've already thrown out a term such as burden, but let's talk about indirect rates. If you're a government contractor familiar with the concept of cost reimbursable contracting, you're probably familiar with the phrase indirect rate. But what exactly is meant by indirect rate when you take that phrase together? So it's not something like a beautiful day where you get it right away. So let's talk first about indirect. What do we mean by indirect? Any indirect expense that is not identifiable to a contract, such as business liability insurance, utilities, rent, those by definition are expenses that fall into a category of indirect because, again, they're not identifiable to a contract or a grant or a program. So think of it in terms of indirect expenses. Rate, what is meant by a rate? A rate is expressed as a percentage, as you can see in this particular slide, where we have a numerator divided by a denominator, also known as a pool and a base. And the percentage that you're seeing on this slide, the 15%, is also referred to as a burden. So it's an indirect rate, which means indirect expense rate percentage or burden that is applied to your direct costs. And we give some examples of what those rates are. We're going to talk about them in a little more depth in this webinar. One thing that came to mind, and I just want some clarification, even though this is a series of webinars, and this is part 1 of 5, not all 5 parts cover this topic. We will cover the topic of indirect rates or burdens in today's presentation, and the next part 2, will be on a different topic, although related. So with that.
Okay, thanks, Chris. So we're going to talk about the first type of rate that we've seen in government contracting, and that is the uniqueness of a single indirect rate. And what that is basically is one cost pool, and it includes components of the fringe, and it would include components of even a little bit of overhead and G&A, all in one numerator, one cost pool. And the allocation base is typically direct labor dollars. We see this as a type of rate that's used for A&E, architect and engineering firms and construction firms. Sometimes construction firms will take the fringe part out and call it a labor burden, but we're just going to right now deal with a pure single overhead indirect rate. So let's go to that. You're seeing something that has a lot of different colors in it, this tab, the single overhead rate pool and base summary. This is actually from the DCAA, Defense Contract Audit Agency, ICE, incurred cost electronic template or model. And that template and model does not have this one. We had to alter it to put this in, but we have some contractors that just have one pool and one base. So this is the summary of what it would look like. And basically, when you go down here, you'll see there's the numerator, pool, 312 is kind of small, I'm sorry about that, and a base, 230,000 or so. And the resultant rate is 135 and 76.76%. So in looking at the detail, that's nice. In looking at the detail there, you can see the variety of expense accounts. One thing that DCA really wants to see is an account number, a general ledger account number. however you present this, whether you use their ICE model or not. So like with QuickBooks or something like that, I'm assuming you can add an account number, but sometimes you can do it without it. You would definitely want to show the account number. So that's important. It starts with, as you can see, the description, incentive comp, PTO is paid absence, and you got holiday leave and group health. And you go down and you see the first set of accounts are fringe benefits. Then we get the business meals and computer stuff. And we go further down into equipment. And then labor, you can even see bid and proposal, which normally would be allocated to the general administrative pool, cost pool. But here it's just one pool, so they broke it out. And they had the capability of breaking out labor for independent research and development, though they had none. Then they have the labor for the overhead, and we'll go on to the next one. And you can see that on the far right, the grand total is 312, 340, it looks like. So what you see in here is other items, accounting fees, depreciation, but accounting fees generally would be in G&A. And then you see a series of unallowable accounts that go into the 9,000 series. And you can see this middle column. So it starts out, if you go back to the prior slide, it goes back to the total amount per general ledger, any adjustments, which would be unallowed, and then what's claimed, what you're claiming to the federal government. And so things like interest, contributions, key man or key person insurance, that's where you have insurance on the lives of the highest level people, the key person, probably the people that actually get the business there. And should they perish, the organization gets that, not the families. That's why that's unallowable, and some miscellaneous and other items there. So this is the entire cost pool and base. And one other thing I would like to mention is the way that the ICE model is set up here, even though it has just one column here, generally there are other columns that have been hidden here, and they're for departments. So if you're really a little bit larger, you could have even an overhead, and especially in general administrative, we think of like finance, executive, or HR, purchasing, IT. Those departments could be broken out, and then they add up to the total general ledger. So this might be a total or an individual one, and this would be the grand total. In case this situation, they equal each other. And then we go back and we see the total numerators is there. And then if you go back to the front page here, you're seeing 312, 240 over the allocation base of 230, and that gives you 135. So hopefully, just by going a little bit slower over this, you get a sense of how this indirect rate works. The style of these templates are the same from the ICE model. And I believe that yellow generally is what you enter, right? And the green that you're seeing below is a formula of some kind. The dark blue are linked cells. Of course, this is not inactive because we're in a PowerPoint. So with that, there we go again. We got the total of the numerator. We're going to go into now multi-tiered indirect rates, meaning that an organization not just has one, but multiple indirect rates for your consideration. This is typically what we see. However, I would say this again, there are a lot of smaller nonprofits that are, government contractors that are emerging, and they may just have a fringe and a G&A rate. And they're just a little too small to have an overhead rate. We'll go into the big question of the day, what's the difference between overhead and G&A in time, but they just aren't large enough to have a separate overhead rate. So these are the rates that are often and typically used by government contractors. And what we see here is just first level is direct costs. On direct costs, there could be a fringe that's allocated both to direct labor, indirect labor, such as overhead and G&A. Occupancy that's allocated between overhead and G&A, in this example on square footage. And if you think about it, you've got an overhead, you've got a G&A, how to allocate that rent between the two, how to allocate even little things like postage and printing, and you scratch your head and say, how do we even do it? This is one way to do it. We'll show you how that works. And of course, wow, what happened here? My apologies. If you click the wrong thing, you get the
wrong results.
Right.
But we're good with that.
So the top level is G&A, and it's applied to something called a total cost input base. When I talk about the presentation of typical negotiated rates, what I'm saying is sometimes fringe benefits and sometimes occupancy, especially occupancy, could be an internal allocation. But in this case, and under this scenario, the negotiated rate is going to be an occupancy. They're actually going to negotiate that with DCAA or the ACO, the Administrative Contracting Officer, or whoever your civilian agency person would be. The same with the fringe pool. But these two rates below could be, in a sense, a part of and integrated internally and not negotiated. So there are many different ways. There's no right one way of a structure. However, the way you put it together, there's a right way. If that makes sense.
In the end, when you're putting it together, you're looking for maximum cost recovery. So in this example, we added an extra tier. We call them tiers for the different delineations of indirect rates: fringe, overhead, G&A, occupancy in this case. But the idea is a maximum cost recovery. So this would be a model for a contractor that actually has perhaps an office that's a home office, a headquarters location, or perhaps they're actually building product for the government and they want to recover those costs. And certainly it's something that, as Paul points out in this slide, is negotiated.
So the typical indirect rates you're going to see are overhead and general administrative, and then fringe is certainly one that's used often, or it could be internal, and occupancy could be internal just via an allocation.
That is correct, yes. So fringe may be a component of direct labor, overhead, and G&A, but it may not be a separate tier. And both fringe and overhead tiers, occupancy tiers are what we call intermediate in the way they're allocated. Because an example of fringe benefits, fringe does follow direct labor. Your direct workforce gets fringe benefits, your overhead staff gets fringe benefits, and your G&A staff gets fringe benefits. So that's why it's intermediate. Service centers.
Yes, sir.
Okay, well, service centers, I just mentioned, they're intermediate cost objectives. So there could be any number of service centers within G&A. You may have, if you don't want to get a distortion in your allocations, you may break up your G&A into separate departments, such as human resources, IT, and whatnot, so that they get a fair and proportionate allocation of G&A. Other examples of service centers might be, you may have a copier center, and you're using an allocation base such as copies per department in order to come up with whatever the logical allocation should be for the use of that particular copier machine, for example. So there's some examples of service centers, and I mentioned earlier, again, fringe benefits, occupancy. And again, it can be any number of things that are ultimately reallocated to other tiers.
Exactly.
Hence the name intermediate. And there's some examples of.
So this is like the cost pool for fringe benefits, and the type of things that you would see in a fringe benefits cost pool is paid absence, PTO, or you could have a vacation, holiday, and sick leave. But sometimes they combine vacation and sick leave, and often hopefully give you a little bit more days there, but it just is an easier way to account for that, and to get out of just the sick leave kind of thinking, where it's just paid absence. Payroll taxes, of course, all of them that are required, pension plan, group insurance, health, life, disability, tuition assistance, public transportation, sometimes you'll see in fringe benefit pool.
So that brings us to a fringe benefit report. This is an example of a report that would be presumably generated by a purpose-built accounting system, a cost accounting system that's designed for accounting for costs on a government contract. So in a very simple model here, or a very simple example, we have a fringe benefit pool, which is the numerator over a denominator. And you can see the accounts that are in the pool. And again, we're going to show you an example here in a moment that gives you a few more accounts. But in this particular case, we only have 3. There's going to be more than that. But the allocation base, and that is, again, the denominator for calculating that indirect rate, that's going to be based upon a logical basis. So when you think about fringe benefits, what would be a logical allocation base for fringe benefits? Well, since fringe benefits follow total salaries and wages, then you have total salaries and wages as your allocation base, less paid absences, because paid absences, vacation earned, paid vacation used, those are going to be in the pool, whereas you don't want them to cancel each other out by including them in the base as well. As far as the adjustments are concerned, in this particular tier, this intermediate tier, it is the basis of an adjustment because it is going to be reallocated. So typically you will not have adjustments to your pool and your base from things like bid and proposal effort or occupancy and so forth. So there's an example of a fringe benefit report. If we go to the next slide, we're going to give you a few more, little more detail. Some examples of the types of accounts that you'd expect to be in the fringe pool. And this is not all encompassing, and there may be fringe benefits that you'll leave out of the pool, such as certain perks because they're unallowable. We touched on unallowable on a preceding slide, one of the earlier slides, but there's going to be, this is just an example of what a fringe cost pool could look like, but again, it's not all encompassing. We go to the next slide, and we have the fringe allocation base, and very similar to what we had seen on the report that we showed. This is showing exactly what you would expect in the allocation base, and that would be G&A labor, B&P labor, IR&D labor, and just for definition purposes, IR&D, sometimes known as IRAD, it stands for Independent Research and Development. And B&P is bid and proposal labor, and we're going to be speaking about those in more detail later in the presentation here today. You have overhead labor and you have direct labor. So those are the components of total salaries and wages. And again, you don't see occupancy labor in this particular instance, but you also don't see any kind of paid absences. There, it's understood that they'd be subtracted from the allocation base. So, and that will yield a rate percentage, as you can see.
Okay, just to say a little bit more about the allocation base here. What they do is, what we're going to do here in this square is you're going to see that the labor, the 90,007, as a percent of the total denominator, allocation base 779,893, is 11.54%. And you'll go down and keep doing it for each one, direct labor being the last, 81.17%. of total labor. And why that's so important is that what we're going to do is multiply the 1154 times the 90,000, and you're going to come up with 24,005 for the amount of fringe being allocated to G&A labor. The amount of fringe allocated to, for example, direct labor is 168,827. So this allocation base here, we spend a lot of time showing the details of each one, because we're going to see later 24,005 for fringe benefits on G&A labor, or for overhead labor, it's a smaller amount, 8817. And there's another number, let's see, what else we got here? Yeah, this 175, 178. So for example, we need to know where fringe is being allocated. The total is 208,000. But 175, 178, this is a smaller amount, is going to be allocated between BMP, independent research and development labor, and direct labor as a part of the G&A base. And so we're going to see this number later. So what we try to do is do subtotals and other things to try to help one another so that your indirect rate computation and how it's applied, there are subtotal numbers that can be used later. And when the government auditors, DCA particularly, look at this, they can come back and they can look specifically and see where these numbers relate. So as accountants, everything is a part of reconciliations. This is just another internal reconciliation that shows where certain numbers come from. So this is a very helpful base.
Occupancy. So very similar to Fringe in the sense that it is an intermediate pool. It is redistributed again to other tiers. So in this particular example, occupancy costs are just that. You've got your insurance, you've got your rent, you've got property taxes, you may have utilities, and those are just examples. And so that would, and then you've added a fringe allocation. Again, fringe is an intermediate tier, so you're going to go ahead and for any types of costs that are labor-based, you can have an allocation for fringe. In this case, there is not a fringe allocation, and normally there wouldn't be unless, again, there's going to be a labor in the pool, and that would be what would be an occupancy type of labor. Well, if you have a plant supervisor, or maybe you have a night watchman or something like that, that's where that would come into play. Now, what's interesting, in a sense, is the occupancy base, which is, again, the allocation base. And you can be very creative with your allocation base when it comes to an occupancy pool. So you may do it based upon head count at your facility. You could do it on square footage. You could do it on ceiling tiles, for example. So you can, whatever makes sense as far as an allocation base for your occupancy pool. Is pretty much a user definable one, as long as it's reasonable and within the guidelines of what would be considered to be a reasonable base for an occupancy pool.
Okay, and just to say just a few other things about this base, going down to that's the pool, and then here's the base. And what I really want to focus on is just the breakdown there, just to make sure it's perfectly clear that that there's a square footage of 2,404 assigned to G&A, 16,088 square feet to overhead for 18,492. And then again, those percentages that are determined, in other words, 2,404 is basically about 13%. And it may be hard to read, and the bottom number is 87%. So 13% of this total amount of the base of 154,803 over here. So 13% of this equals the 20,125, and the 154 times the 87% equals the 134 number here. So what I'm trying to say is these are where these numbers are actually derived. So you have a sense of that. And then the last column is just agreeing with the general ledger accounts. These numbers here too will show up in the G&A and overhead pools. Also, not for now, but for later, these numbers are used for other schedules as well, which we'll show you in part 3 when we get into something called the cost of money. We won't even go beyond that right now, but these percentages here are used in determining also the cost of money at a later time. Not today, but just to show you that these subtotals, again, are necessary for different purposes.
So last thought on that before you launch this poll is that, you've got a unitized base for occupancy and typically a monetized base for other components of indirects.
Great, thanks, Chris. So we've now reached our second polling question, which is, we have assessed our indirect cost rate structure and identified areas of potential non-compliance, A, within the last month, B, within the last year, or C, not yet, but we anticipate the need soon. And again, please take a moment now to answer. While everybody's filling in their answer, I'm going to provide the second CPE word The second CPE word is winter, all lowercase, WINTER. Remember, if you want to receive CPE credit, please jot these words down because you're going to need them for the survey following our webinar. Again, the second CPE word is winter.
All right. So now we're going to go on to overhead. And this again is a little bit different than that single overhead that we saw before. This is within the multi-tiered rate structure environment. And we always have that age-old question, what's the difference between overhead and G&A? Well, overhead kind of relates to smaller segments within the organization. Business lines, like you may have a logistics area. Maybe you deal with engineering or manufacturing or fabrication and need separate business lines for that.
On-site overhead, client-side overhead, home office overhead. Yeah, the possibilities are pretty infinite as far as how much you can segment the concept of overhead. But one thing that I think we should define up front, the question was that Paul had asked hypothetically, what are the differences between overhead and G&A? So to put it in a nutshell, overhead is division, department, or business segment related, whereas general administrative benefits the business as a whole. So, and there will be some overlap between the accounts. So for example, if you have a G&A tier and you have an overhead tier and you have a facility, well, perhaps part of that facility will be allocated to G&A and part of that facility cost will be allocated to overhead. So there are some shared accounts within overhead and G&A. So just think of G&A as benefiting the business as a whole and overhead being indirect costs associated with a particular division, department, work group, line of business, location, and again, the possibilities are infinite.
Yes, and that's very good, Chris. And in fact, what you'll see in an overhead typically is a department head or vice president of that particular unit that's running it, and they may have some assistants in the office, and they're definitely going to be in the numerator in the overhead. And it's just because that individual probably was and still is a technically, qualified individual that could work on a contract. But the idea is there's so many contracts or so many task orders that another way to put a person in the overhead is simply because there's just too many things to charge.
That's exactly right. You cannot identify that labor to a specific, what we call a cost objective. Another way of looking at overhead versus G&A is that you're going to have general and administrative expenses regardless of whether you have any contracts or tasks to manage. So general administrative expenses are going to exist regardless. And earlier, Paul said when you're just starting out, you may have fringe benefits and you may have G&A, but you may not have overhead. Well, that's because you don't have contracts. So where there are no contracts, or grants, there's no overhead. Whereas G&A will exist regardless of your business mix.
Yeah, that's a real good point. One thing we can just simply say as far as the definition of overhead, it's a cost pool. And it often goes over direct labor plus B&P labor and could include IR&D labor and B&P labor. But there are many different ways for an overhead base to be. There's no one right one, as long as whatever you choose, you're consistent. And it's the typical type of stuff that applies to overhead. And this is a rate that always is presented for negotiation with DCAA. Now, Chris is going to talk about the output reports that are going to be from that. And I apologize that I did not show these things. And now Chris is going to get into the output report.
Okay, so here's an example of a overhead report, very similar to what we saw earlier with the fringe benefit report, where you have a grouping of accounts or a pool of accounts, if you will, that are specific to overhead. And you'll see overhead labor in this example, travel, supplies. As I mentioned earlier, there's depreciation as well. As I mentioned earlier, there's going to be some overlap between overhead and G&A and how you want to split that particular difference. How much do you want to allocate to G&A? How much do you want to of a like expense allocate to overhead? That's just part of a budgeting process. So those would be the accounts that would, or example of accounts. We'll get into some more detail that could be in the pool. And then the base, what would make sense? Well, direct labor is going to be your base for overhead. So that would again be direct labor, B&P labor, direct labor overtime, for example. If you have independent research and development, that labor would be part of your base. Your base is typically going to be labor. It can be labor dollars, and it can be labor hours, but almost exclusively your overhead, with a few exceptions. You may have, for example, machine overhead, machine hours for overhead associated with a particular manufacturing process, but this is a very typical rate structure. Now you'll notice that the unadjusted pool does not include, you have the unadjusted pool before you allocate fringe. So the fringe benefits associated with your overhead labor would be additive to give you your total adjusted pool. And you see the same effect in the base. What you're seeing is a fringe allocation for all the cost elements, those labor elements that are in the base, to give you a final adjustment as far as your pool. And at the bottom, you'll see the actual percentage of the pool in the base, which is, of course, your indirect rate. It's also, you'll notice on these reports, you're going to see a Y to D column. What's Y to D? It stands for year to date. One I think salient point about indirect rates is that each year brings a new rate structure. So you have your year to date rates and you have your period to date rates. So they'll vary month to month. The rates that you really want to pay attention to in any case would be your year to date rates, because you can have spikes in your rates any given month as far as the month to date is concerned, or period to date, if you will. It doesn't necessarily have to be a month. You could have 13 4-week periods, but however you define that period, it doesn't really matter. The bottom line is you could be looking at your year to date rates and looking for fluctuations in that. So there's an example. If we go to the next slide, we're going to get more detail.
Yeah, and this comes from the DCAA ICE template again, and you can see the items that are filled in there. And basically we start with office supplies and small equipment, temp help, and there's a variety of things like telephone, telecopier, fax machines. We don't see as much of that, less and less today. Equipment rental, and looks like recruitment and so forth, dues and memberships. So you could see that recruitment could be in both an overhead pool and in G&A, and some of the other items like office supplies, business mails, relocation. So these are things that are unique to the business line that you're doing. And it could be, remember, some overheads could be geographic in nature. You just simply have like one in the DC area, and you could have one in Norfolk, Virginia. And because you'll find that the pool and the base, the ultimate rate will be a little bit different. Norfolk tends to be a little bit of a lower cost area than Washington, D.C. So the rate may be a little bit lower than actually in Washington, D.C. area. Let's go to the next slide. And this is just some more of the pool.
Yep.
And you can see there how that works. There's some auto expense that they removed from the 32,429. Looks like 23,023, and they got a result of 9,396. Now, Chris and I were talking the other day, and we just say, try to make your rates simple. Try to make them something that's not overly complicated. And a lot of people will have like some unallowables in the overhead pool as well as the fringe pool. And we're just saying, if at all possible, and they could be related to the company, why not just put it in the unallowables for G&A, which we'll show you, because as you'll find out later, you can't fragment the base. So it means then that for this overhead, the total amount of the overhead cost pool will go into the G&A base. And we'll talk about that later. It's a little bit confusing and maybe not intuitive. It seems to not make as much sense, but it is what you must do. So, Go ahead, Chris.
Yeah, just another comment on that. We haven't gotten to G&A. We don't want to get too far ahead of ourselves because we need to talk about the components of the overhead base here in a moment. But effectively, what Paul had mentioned, you don't fragment the base. What that means is you will include unallowable expenses, and that'll be part 4 of our webinar series, in the base, but you will exclude them from the pool. And we'll talk about that a little bit more, but certainly that's just something to just get that definition out there. What do we mean by fragmenting the base?
Yeah. And if you go back just to the prior slide, you'll see again, this even though we said it's best to put unallowables and relate them to the bottom of G&A, which often they'll, like this is a 7,000 account, you need to make your unallowables a 9,000 account. Again, there's no right or wrong way as long as you segregate unallowable expenses, but this makes it a little bit more complicated. But in the event that you have relocation, some of it was unallowable, note 1. And again, this is the total per GL. This is the adjustment, the disallowed amount, and this is the net claimed amount. So there was dues and memberships that was unallowable, and we have here marketing. Looks like, yeah, marketing.
Yep. You had a portion of marketing that was backed out because it was unallowable.
Yeah, and auto
expenses as well.
Let me just tell you something for those of you who feel you must give a lease or something to some of the top executives. Another way to do it is just say it's worth, I don't know, maybe it's worth $40,000 a year or whatever. That you can just, it probably is closer to 20 or so or less, but say it's 20,000. Instead of just doing it, just give them a one-time raise.
That'll work.
And then you're not dealing with auto expense, because you see, when you record auto expense, you've got to do it like the IRS requires you to do. You got to log those miles.
That's right.
And even if you got a computer program that does it for the person to make it nice and easy, who's going to really keep track of those miles? They're not going to want to. And so you get nothing. And therefore, the way it works there is it's just, the log miles times the mileage rate that the IRS does. Or you can take the value of a car, and you could try to depreciate it. But their idea of a car would be something like, a little, very, very little, very, very basic, Toyota Corolla, not a fancy Jaguar. So it's just something to think about in your approach. There's still just a little bit more one thing. We want to talk about the allocations that are right there. So you can see that occupancy of 134,678. If you go back, you'll see that. And the fringe of 8817 that applies to indirect overhead. And that labor amount was, let's see, somewhere in the slide, somewhere lost in the slide. So in any event, apologize, but it's just not listed, is it, in there? You'd have to almost go back to the fringe base. It could be something where we had a hidden cell or something like that. But there is supposed to be in here overhead labor. And the fringe on it would be, what's the amount? Did you look up the fringe, the labor associated with the fringe?
No, I don't see the labor on this report, to your point. I see office supplies, and I don't see any overhead labor in this detail. So
okay. But if you go back to the fringe pool, the fringe allocation base, it would be, hold on one second, because we want to get this right for you. Even though it's been suppressed somehow, it was $33,060. And $33,060, applying the percent of the base, gave it $8,817 that applies to the overhead labor. So that's part of the step down. That's part of the allocation order for fringe to overhead labor. And of course, occupancy was 134,678. It was only between occupancy and G&A that occupancy costs were allocated on square footage. We just wanted to show you that. And then you can see what happens is you got like 355,000, you add 134,000 and 8,088, and you get 499,174. That's the claimed and approved overhead net cost that's going to be over an allocation base. And I believe in this example, if we go back to one, it was like 60% or something like that. So now let's move on to the allocation base for overhead. You can see there the first thing up here is something called total contract labor. For some reason, when DCA put this model together, they just assumed that you would understand that contract labor was direct labor. So that's direct labor. There is an application of IR&D, independent research and development labor, bid and proposal labor, plus the associated fringe. Remember when we went way back there and we said, hey, there's a subtotal in fringe. Do you need to know? Well, we did that so that we could come up with this that not only will be in this base, but also in the G&A base of 175,178. When you add it all together, it's $832,002, and there it is, 60%. So as we go through, you know, we will have a Q&A at the end, and that Yev will be our moderator for. And we hope that as we go through, if there are questions that you're thinking about, you know, please let us know. Please send them in as we go along. That'll make things even more interesting and more relevant. Chris, do you have anything to add on the overhead base?
Just as far as the overhead base is concerned, I mentioned earlier that it could be a unitized base. In other words, it's unitized regardless, but instead of being direct labor hours and BMP labor hours and overtime hours and so forth, it can be an actual hours base as opposed to a monetized base. And the reason you would do that, in case you were wondering, is because you may have highly paid executives and then not much in the way of middle management, and then mostly lower paid worker bees, if you will. So to give you an example, we had a client who had a laboratory. They did lab tests, and the executives, you know, made decent money there, and the folks that were working in the lab were wage earners. And there were, like I said, there's not much in between. So therefore, if you were to include total labor as your base dollars, you would have a distortion. So hours better represent your overhead rate in that particular instance, where you have highly paid individuals, very low paid individuals, and not much in between.
There you go. So again, this is just a little thing to emphasize the different items within the overhead allocation base.
Mm-hmm.
Now we move on to a bigger topic, general and administration.
Which benefits the entire company, as we mentioned earlier, as you can see in the subtitle.
So the overhead cost pool is going to have a lot of different things. And like Chris correctly said, it benefits the entire organization. And, you know, these are things that basically don't just specifically identify to one contract or one function. They support everything throughout the organization. And it will include, you know, an allocable portion of fringe on indirect labor. And it does also, in this example, have occupancy that was allocated to it. And the types of people you can see in there, without us reading off, you know, it's just these general and administrative functions that are performed that support the organization. Okay. And just we're trying to do at a top level, there are many different allocation bases, primarily two, I should say. Well, a third if we think of subcontracts as a subset. And so the most popular one, the one that DCA gives you the gold star if you've got in most situations, what we call a total cost input base, which is basically made up of direct labor and applied fringe, other direct costs, and you can see them. But there is a value-added G&A base, and it would exclude subcontracts, material, and maybe consultants, depending upon how you set it up. And Chris has a really good background on how value-added even came into being.
Well, effectively, the question is, why is it called a value-added base? So, conceptually, I understand total cost input includes all of your costs, direct and indirect. But when you split out material handling, when you split out subcontractor management, the concept of value add means the government is getting value from that type of a rate structure where they're excluded from your base because the contractor takes over the management of the materials, the purchasing, the actual assembly, and the management of subcontractors. Therefore, they're adding value to the government by inheriting those managerial tasks. So they're doing it so the government doesn't have to do it, hence value add. And but yes, DCAA typically does prefer the total cost input base, because when you take those costs out of your allocation base, what does that do? Well, your percentages go up. So what it does is it makes it appear that your G&A is much higher without those costs in your base. On the other hand, the flip side of that is the government's getting wise to the concept of value added, not only because you're handling administrative functions that they would otherwise have to handle themselves, but because you can have excessive pass-through, what we call excessive pass-through. So if you have lots of subcontract labor, that's going to be a fairly big percentage. And remember, you're going to be allocating those rates against all of your direct costs. So therefore, you get into that fine line between what makes sense as a value-added base versus total cost input in terms of the actual percentage of costs that are being passed through. And to the extent they're excessive, the government's going to want you to have a subcontractor handling pool as opposed to having it in your allocation base.
So just briefly and conceptually, what makes up the preferred DCA, because we're talking about complying with DCAA, total cost input base, is the first item is direct labor. This is typical of service organizations, for which I believe probably most of you are service. The few that aren't, it'll be a little bit different. Fringe applied to the direct labor base, okay, as a part within the G&A base. There'll be overhead, and it'll be applied to direct labor and Fringe, and if there's B&P, appropriately. And then if there's other direct costs, and other direct costs will be a part of the allocation base. And lastly, we can see that G&A would ultimately be applied to where you see the within the box with the dots. So this just gives you just a quick overview conceptually of how this rate is done. Again, what's very important is that we look at how does this look in a report format, and Chris is going to go over that because this is the way you're mostly going to see it in more of the sophisticated softwares.
Exactly. So what we've done is actually on this particular presentation, because there are so many accounts in your allocation base, we've kind of split it up, but that's okay. So we've got your G&A pool in this example, which includes G&A labor, travel. We saw those same costs: travel, occupancy, supplies, and overhead. And as I mentioned earlier, you're going to have a pro rata allocation. What's going to be considered overhead, what's going to be G&A. You don't have the methodology of identifying those to one component of an indirect tier versus the other, one class of indirect tier versus the other. And then you have your allocation base. And in this case, again, total cost input, not value added. It would also include subcontracts. And if there were materials in this particular case, they would be in the base, and you would have everything else in the base as far as your expenses are concerned, including unallowable expenses. So what you're seeing here is the, we'll draw some circles here for everybody to train their eyes. Okay, so you have basically your unadjusted pool total, you have a fringe allocation. Now notice you'll have a bid and proposal allocation. That's new. And for those of you, and we're going to speak about bid and proposal here in a moment, but for those of you who are not familiar with that concept, is the government would like you to pursue government contracts, and they have a unique way of actually reimbursing you for any bid and proposal costs that you may incur. And the way they do that is effectively there could be opportunity costs associated with somebody who would otherwise be a direct billable staff member who has to be pulled off the job to help the red team create a proposal, and in particular the technical proposal, because the G&A folks, chances are, will handle the cost proposal aspect. So you have a technical proposal, you need to borrow labor from folks that would be otherwise direct. This is the government's way of reimbursing you for that effort by taking that B&P labor, which is treated as direct labor initially, burdening it with overhead. And you noticed earlier when we showed the overhead pools and bases, you noticed that there's B&P labor involved, or included, I should say. And then it's reallocated. It's actually recouped through G&A. Hence the idea of a B&P allocation. And also, if you had independent research and development, it's handled the same way. Either be a line item for IRAD, and that's your final adjusted pool total, and the same is true of the base, although we're backing out a fringe allocation associated with overhead labor in the allocation base, but you'll see B&P, and ultimately you're going to have a rate.
Mm-hmm. Okay.
So we'll go into some details here. Pool detail.
So again, we use the DCAA template, and again, you see its style there, and it's pretty noticeable style with all its different colorings depending upon whether you're inputting or as a calculated field. And we start with G&A, the salaries and wages, 8310 in this case. Again, noticing we put in account numbers, or else DCA may return it and say this is not an appropriate cost submission, which we'll talk about in part 3. And you can see legal, audit, accounting fees, travel. Now with entertainment, there's an amount that's disallowed from that for certain types of entertainment. They put in advertising, promotion, bad debts, and it looks like convention, seminars, interest expense, and at the bottom, marketing. And basically what they're saying is that those, either part or all of those based on the FAR is unallowable. But I would even do it a little bit differently and set up 9,000 accounts so that it's at the very bottom and you can see what's been removed. Now there may be a question, should we even show the 9,000 counts? And yes, you should. You just show it at the bottom of the pool so that they can see that it once was it's in the GL, it's been disallowed, and this is the claimed amount. Will be 0 for those unallowables at 100% unallowable. It's just depending upon how you want it formatted, how you want it to look. So you see the typical things that are in, like you'll see insurance, equipment rental, you'll see office supplies, you'll see postage, printing, and all of those things. And that's also in the overhead pool. So again, how do you distinguish? Well, first, if you can directly identify them as either unique to overhead or G&A, then do so. But then when you're beyond that, how do you allocate? Well, we had an occupancy expense that I allocated certain things between overhead and G&A. Now, interestingly enough, if you notice, we go back, because I'm looking at this now, we probably had cut short the G&A cost pool, and we didn't put in just about everything. We may have, there are accounts that go on and on and on and on and on. And in fact, that's why in Chris's example with the SIMPAC output reports, we just made it a few accounts. So, but in any event, we now go to the subtotal, which you're going to see up here. And this is before any other allocation. So the way DCA sets this up is very similar to the way you'll see in typical softwares, where you'll have the unique parts that ultimately reside in the G&A or overhead cost pool, in this case the G&A, before you have intermediate allocations or service center allocations of occupancy and fringe allocation. And there they are, you can see them together. And then we get in, and then it subtotals again at 265, 830 or so. And then what we have is the two components that reside. This is the final place that they wind up. Independent research and development and bid and proposal. They wind up in the G&A cost pool. And we usually put it at the end. We put it after the service center allocations. So we have independent research and development, and you can see all the little red stuff that goes around. And that could be, and the same for a bid and proposal. And let's just do the bid and proposal because it's something we more easily identify with. It's bid and proposal, what we call other direct costs associated with B&P. It's the identified B&P labor, which originally was treated as a direct cost. I know it sounds confusing. And then we moved it over to G&A cost pool with the applied fringe and applied overhead. And on the far right, you can see, just like with IRAD, B&P has allocated numbers. That is, the two unique numbers of B&P ODCs and B&P labor, and then the allocated amounts of fringe and overhead go there. Now you might say, well, shouldn't there be an allocation of occupancy and fringe? Yes, there was. It was already done in overhead, and therefore then it just that overhead allocation picks those items up. So you can see that there is a concept of a step order and a certain order of allocating expenses, and you have to make sure that you're allocating appropriately or you're going to get a mess. Chris, anything comes to your mind at this point?
No, I think you've explained it very well. We can move to the next slide.
Okay. Do you want to?
Well, if you just go to the next slide here.
I am.
All right. G&A allocation base. Again, this is total cost input. Let's go to this slide here.
Okay.
Right. You want to kind of elaborate on this one? I was just going to kind of point out how, as I mentioned earlier, overhead, B&P and IR&D labor get removed from the base. They're adjusted out of the base.
Yes, that's in here.
Okay,
that's in here.
That's what I want to.
Okay. So before Chris gets to that, let's just talk briefly that you'll see up here again, the contract labor. Again, anything that's contract, travel, that means direct. So you have direct labor, direct travel, direct material, in this example, another direct cost, and subcontractors. And that gives you the 2.6 million. And then we start to get into the overhead. Overhead is a part of the G&A base, but at this point, this is where you're going to scratch your head and say, this is total overhead with unallowables in it at 532, because unallowables must remain in the base to get their allocable share of indirect cost and the fringe associated with that overhead base.
Yes.
Now, Chris would like to talk about.
Just basically, I just wanted to emphasize that, because you have IR&D, and this is actually with respect to IR&D and B&P, and the way I mentioned how it's treated, basically it starts out as direct, and then it becomes burdened with overhead and fringes. Well, you'll see that because those costs are already transferred to the B&P pool, the G&A pool, they need to be brought out of the base. So that's why you're seeing those adjustments. So you're not double counting them, if you will. But another thought I have as far as this goes, occasionally contractors will ask us, well, do we really need to do this? Do we really need to have our direct labor involved in our bid and proposal effort? And if the answer is no, if it's handled completely by your G&A staff and your technical proposals aren't that technical that they can't handle them, then you can actually not go through this exercise and just charge B&P to your G&A pool and be done with it. Okay. So there's no, it's indirect from the start to the finish.
And just to go back to clarify on this one here with the next set of circles, again, as Chris has discussed, but just to show you specifically, this is the amount within the G&A base if you have independent research and development and or B&P where there's applied fringe. That applied fringe comes out of the base and goes into the pool. And then the same with applied overhead. Yes. It comes out of the base, the G&A base, and goes into the pool, simply because that's where ultimately B&P, if you remember, if we went back, resides in the cost pool. So there has a $3.3 million base with almost a 10%, 9.98% rate. So you can see that there's, even in a more simplistic model of just fringe and overhead and G&A with an internal allocation of occupancy, you can see that there's a lot of complicated internal charging that's going on. And there is a process. And I recommend that if you use the DCA ICE model template, which is free and it comes down from the ICE from the DCA website, you can just download it. My recommendation is to use that because it'll help guide you through and get a proper rate. Of course, if you have just a G&A and a fringe, or like we showed in the very beginning, a single overhead, they don't have those templates.
And with that, we've reached our last and third poll question, which is, does your organization have accounting practices for identifying and removing unallowable costs from the indirect cost proposals? Yes, no, or I'm just not sure. And with that, also, I'll provide the third and final CPE word. Again, please make sure to jot this down as you'll need it for the survey at the end of the webinar. That third and final CPE word is January, all lowercase, January. Again, the final CPE word for today's webinar is January, all lowercase.
While we're showing the results of the poll, the poll, I should say, we have about 15 minutes remaining before we open it up for questions and answers. So we're going to kind of go through some of the other concepts we mentioned earlier, just to reinforce what was discussed earlier in the presentation. So starting with BMP.
Okay. And Chris is going to talk about it. It's Chris and I.
Yeah, we'll collaborate.
We'll collaborate. But it's treated like a direct project, and it's subject to Cost Accounting Standard 420, although you don't need to know that, but it is within the FAR. There we go. And it's helpful if you establish a special job number for that BMP project. Then a proposal direct labor receives, as we talked about, fringe and overhead application. BMP ODCs are tracked by job number, and independent research and development is allocated the same way. And then you can see what BMP project cost is comprised of: the labor, the fringe, the overhead, and the ODCs. And then BMP, as we said before, is transferred to G&A and allocated over the appropriate G&A base, which is often TCI, total cost input. BMP is incurred generally after a bid, no bid decision is made by management. Up to that point, a lot of people call that business development or marketing, but really it's direct selling expense. And at a later point, we'll go into what more is direct selling, because direct selling is a more appropriate term. And it is basically the one-to-one interaction with the federal government. And that's, for most of you, that's really what you're doing, unless you're doing an exhibit that you would show at a trade show. There it would not be allowable because it's one-to-many, or like advertising. But you technically could develop an exhibit and only show it to the government and get reimbursed under direct selling. Now that will really cause maybe some questions. I hope so.
Yeah, because FAR 31205-1, advertising expenses, promotional expenses are typically going to be deemed unallowable. FAR 31205-37 are selling costs, and there's some overlap there. So as Paul said, if you're using a trade show exhibit and selling directly to the government, then it would be allowable as opposed to being at the trade show.
Right. You just need to be very careful in the way you document that so that they can see that. BMP also includes not only the cost volume, but the actual technical volume. This is where Chris has talked just in the recent part. If everyone's just working on a cost volume, or you're very small, or all you have is a single overhead or a single G&A with no overhead, then everything will wind up in G&A. I still recommend tracking BMP as a separate line. It's good for you. I still think S 420 wants us to at least track it,
yes,
even if it all sits in G&A and it doesn't go anywhere. That kind of compilated circular computation is when you have an overhead and you're going to have direct people that participate in that bid effort. They'll go to overhead, their overhead, if you have multiple overheads. And the same for those that reside within the overhead pool, VP or something who's a technical person, and they're adding their information too. That also would go to BMP in that situation.
That's correct.
So those are the types of things that, again, if you need some help, we can certainly ask the question and we'll be happy to answer on that. But you can see just over time, and this is the definition of what goes in bid and proposal cost, that it gets rather complicated. It may start out simplistic, but it tends to, even this is technically considered, what you're seeing today, as a straightforward simplistic with these 4 different rates allocations. This is not considered by DCAA anything complicated, but you can see the involvement of this.
Indeed. And kind of a final thought on B&P before we go to the next topic is what's wonderful about the world of government contracting, cost reimbursable contracting, is if you're in a commercial environment and you're working extensively on a B&P effort and you don't win that ultimate business, you ultimately don't win that business, you know, that's just the way it goes. There's no recuperation of the costs. Whereas with the government, as I mentioned earlier, they want you to pursue government contracts. They want you to bid. So therefore, they have a way of helping you to recoup those costs where you wouldn't see that in the commercial world. Okay.
And in this chart here, which may or may not be so easy to see, the basic thing to understand here is that although that there's $20,000, okay, or so of direct labor here, if you added them up, the pink actually wind up going to G&A. And it's just to show you again in some kind of graph or diagram, just a little bit different process. When you have an overhead, then you're going to have that labor being, though it maybe start as direct labor, it'll wind up in bid and proposal, which will wind up in G&A. So now we're going to material handling and subcontract administration.
Sure. We kind of covered this a little bit earlier, so we're just going to touch on it now.
Right.
So basically, you know, as I mentioned, you know, the concept of a value added G&A, that would be, again, subcontracts and material handling split out from your allocation base. And you'll have a material handling pool, which would include things such as purchasing costs, receiving costs, loading dock costs, anything that has to do with the actual, as the name infers, handling of materials. So that would be an example. Here's an example of a subcontractor / material. Sometimes they're combined. You have subcontractors and you have material handling. They can be also, as Paul mentioned at the outset, you can have a specific subcontractor pool and you can have a material handling pool. But in this example, you can see how the rate is computed.
And there again, you can see that because this is subhandling, we're actually, a lot of times, the subcontract pools are people that are doing subcontract administration and they're being pulled out of G&A. But you can see the base is much, much bigger. That's also pulled out of the G&A base. So here, the occupancy pool has both Fringe and a small piece of occupancy allocated to this. Just so you know, these numbers do not necessarily come from the prior examples, but this was just another model that I threw in here. So the items that you see now circled or somewhat squared, they're not from the models you saw before. This is just a separate example, standalone. And you can see in the base, you can have anything like subcontracts and or material. And sometimes consultants are included, sometimes they're not. If you have a lot of consultants, you may do that because, again, there's so many of it and the administration of it may, the consultants may obscure the base if they're not included. So these are just different approaches. We're trying to be as flexible as we can. And now we just get into what does the FAR generally say about indirect rates, because I'm sure you'd want to know. And again, let me just stress this one point. A lot of people want to be CAS, cost accounting standard compliant, but you don't really come to that unless you have large thresholds. And so you really need to be FAR, Federal Acquisition Regulation compliant first. So when we say DCAA compliant, we're talking really at this point about the FAR. If you are much larger, yes, that would include the CAS. So, you know, the government wants you to put things in a logical cost groupings. You wouldn't see rent in a fringe pool. That doesn't fit. So they have to kind of work together. You have to define and use appropriate allocation base, especially with intermediate stuff. So again, if you are allocating occupancy, you could use headcount, square footage, labor dollars. There's a lot of things you could use. And someone said even what, the tiles on the ceiling, right?
Well, that would be for, as I mentioned, occupancy. Again, you can have a lot of variations on the theme as long as they're logical, reasonable, and consistent.
Right. So occupancy could have that, but you wouldn't want to see a total cost input on that. It just doesn't make sense.
No,
it doesn't
that's
apply.
right. That's right.
That's what they mean by that. But I like the third statement, which I'll just read because it's so straightforward. When the outcome of it can be achieved by less precise methods, the number and composition of cost groupings should not unduly complicate the allocation. So, this is, I think, where a lot of time, this is the phrase that DCA refers to, where you just, you're $1 million revenue government contractor and you got like 50 rates. It doesn't make sense.
You're right.
It just doesn't make sense. And it sometimes is the smaller people, the smaller entities that over allocate, make it more complicated than it should be.
That's true. And, maybe the audience has come to the same conclusion that, it's complicated enough as it is. So let's not overcomplicate it.
Keep it simple.
Yeah. So coming right along with the.
Yeah, we don't want to, this is where it talks about not fragmenting the G&A base,
Yep.
particularly, although any allocation base. And again, selecting the appropriate allocation base for allocating costs. And that's where we get into the total cost input versus value added, which we've already kind of drilled in, but this is another spot to talk about it, except to say that the total cost input base will also include commercial work. So if you have commercial work, it doesn't matter. I don't even care whether you have 10% commercial work or 90% commercial work or anything in between. All of the commercial work, it stays, especially like with the G&A base, it stays in the allocation base.
Right.
Some people want to do it separately and it just doesn't work that way. And then you may have separate cost groupings for off-site locations. Remember, we talked about geographic, and that's where that comes into it. And basically, the base period is the cost accounting period, which is your fiscal period. Please don't make things complicated like that. It wouldn't make sense. I have seen organizations that have what they call roll forward indirect rates. And all that means is, okay, they're just doing it for January, December throughout the entire year, and then they'll go January, then they'll go February for the prior year. And that's fine for internal purposes, but it's not accepted for federal purposes. And just remember that some indirect rates, especially a sub-handling rate or a G&A rate, can be limited to excessive pass-through costs, which I think they define it's more than 70% of your costs, I guess, on a contract is greater than, if it's greater than 70%. They're not saying it's your application of sub-handling is unallowable. They're saying you're going to have to demonstrate why you're adding value in a different way to that. So that's interesting. So you can see the government's being very careful about this next set, which we won't spend a lot of time on, I promise, as we're wrapping this stuff up and you're getting your questions ready. It's just that there's a certain allocation order. And what we say is that basically you should be doing your service centers first, your fringe, if you have an occupancy, then you apply it to overhead and G&A. It's just basically that approach. And you can see in here that you get that same kind of definition. The other one that's really key is this one. If something is incurred specifically for a contract, it is identifiable to that contract, or indirect, specifically identifiable. If it benefits both the contract and other work, it can be distributed in an equitable proportion based on the benefits received. Necessary to the overall operation of the business, but there's no direct relationship. That's something like G&A. How do you allocate that? So I come up with this diagram here, and unfortunately, we're not able to pictorially or graphically show you, but I just wanted to essentially say these are like direct functions here, okay, for this overhead in McLean, Virginia, this sample here. And then these are the direct costs for an on-site overhead. And then we have a family research direct stuff, family counseling center. Then we have media outreach, a lot of groups, even like our public accounting firm is doing today through GoToMeeting. We're all becoming people that are broadcasting to train people. And then they have business development, bid and proposal, and then they have their typical G&A and what makes up all these items. And you can see the numbering system. But those numbering systems in the direct areas is a job. It could be commercial or non-commercial. And in the indirect areas, it just represents the different functions like executive officers, finance, administration, so forth. So you see down here at the bottom, it says direct contracts and other indirect projects. They're allocated first, something that you can identify specifically, whether it be direct or indirect. That's where it should be done first in allocation order. Sometimes organizations have fringe and occupancy residing literally within the G&A cost setup or structure. Doesn't mean they're going to be totally retained there, but so in this case, fringe benefits, this kind of orange kind of color, is retained within the G&A structure, but actually would be allocated, if you follow my arrow there, to all of the jobs and all of the indirect that has direct labor or indirect labor. And in this unique scenario, occupancy is also allocated on labor dollars as well, would be allocated to everywhere where there's labor dollars. Then they have this thing like we have here at Gelman, Rosenberg, Freedman, where you have some people that for a period of their effort, they're dedicated to producing webinars or permanent recordings or whatever. And in this green area, we have somebody like an engineer or somebody and a little bit more professional type studio with all kinds of equipment. And they reside in media outreach. Well, these costs based on engineering hours or the person that actually runs the studio is allocated to the Family Research Center and is allocated to the Family Counseling Center. So, so it's some of the studio time there is allocated. So you can see there's an order. The light blue is the overhead that's allocated within these groups. And finally, G&A is allocated. So there is a step order to allocate costs, and it's something we wanted to bring to your attention real quickly. In doing this fringe pool analysis, there are many different ways to compare 17 and 18 costs within and this is a very small fringe pool, leave, medical, payroll over a fringe base. But instead of just comparing 1,500 and 1,500, as many auditors would know as flux analysis, let's look at the percentage of the allocation base. 1,500 is 15% of 10,000. In 1,500 is 20% of 7,500. So what you're trying to do is look at many, many different accounts, look at the accounts percentages that have a greater variance and focus on the variance. But notice something, the reason why the rate went up so high in 18 is because the base decreased by 2,500. And one of the last things we're just going to show you is the fact that there is something called a multiplier. And the multipliers are so important because when you use them together, they are able, even under different overhead structures, to come out to a multiplier number that you can compare. In this case, fringe of 1.35, overhead of 1.25, and G&A of 1.12 equals 1.89. So what we're saying, for every dollar spent, you need to spend 89% on these costs. So in closing, and as you get your questions ready, and I think we can go a few minutes over it anyway, just on the questions. That's what we were discussed ahead of time. You have government contracts that are smaller, emerging structures, a single overhead for A&E, fringe and G&A, too small for an overhead. The secret tips in competitiveness, everybody wants a low multiplier because they know that when their proposals that they can win. So what drive costs direct, but remember you got to cover your costs. If you start with somebody who's just a consultant, he's now in the government contract world, he or she is going to use market-driven rates rather than actual RAP rates. Their goal is to catch up to those RAP rates. So we encourage the proper design, the setup for the FAR to get full cost recovery and your cost build up. And we believe the best model that's out there to use is the DCAA ICE template. And so with that.
Excellent. Great. Thanks, guys. So before we wrap up today, we want to answer some of your questions that we have from our online participants and anybody else in the room. And one of the first questions we have is, what are some of the key items that DCAA auditors look at when they're auditing the indirect rates?
Okay. Chris, do you have any thoughts on that?
They're going to be looking, well, first of all, if you're an at-risk contractor, they're going to be drilling down on just about anything. So, for example, I had a client who had expressed concern because DCAA was wanting to get a deep dive into their bank service charge costs, which seemed abnormally high. The reason the DCA was doing that in that particular case is because they're an at-risk contractor. And what they were thinking that the contractor may be doing was taking interest charges from the bank, which are unallowable, and including them in bank service charges. So they wanted to get a sense that, those are the types of costs that could be, quote unquote, hidden in allowable costs. Again, if you're a high risk contractor, if you're in a high risk pool, they're going to really scrutinize just about every line item in your general ledger. If you are part of a pool of contractors, you can have a situation where they do a statistical sampling, which means you can be pretty much spared the burden of your incurred cost submissions for a period of up to 3 years. They'll just take a statistical sampling versus really trying to look at every line item by line item. Then that means you're a low risk contractor. What it really comes down to is that you have a history of not having a lot of unallowables included in your incurred cost submission. So, Paul,
that's a good answer to that. Let's go on to the next question.
Okay. Excellent, great, thanks, Chris. What about some of the key due dates to keep in mind with regards to DCAA compliant rates and making sure they're submitted in time?
Well, there's two basically, and that's the provisional billing rates. And, basically if you're on a calendar year, by January or so, you should be done with your provisional billing rates based on your budget to go forward. And I was just talking with the DCA auditor, and of course she was out in California, but she's saying, we look at all these provisional billing rate submissions in March. So if they're on a calendar year, assuming they're on a calendar year. And as far as the actual annual incurred cost submission, which we will talk about in part 3, that is due 6 months after you complete your fiscal year. So that gives times for the auditors, if you have auditors, or to do an audit review or compilation or whatever, time to do their thing. And then you have time based on post-audit numbers to put together an annual incurred cost submissions, which is due in, like I said, in 6 months. They're not, if you're a day or two late, it's not going to be a problem. If you think you're going to be later than like a week or two, you should let them know and send a letter to them. Chris, do you want to say anything?
Well, basically, if you're chronically late, the DCAA will just go ahead and do your incurred costs submission for you and say that's what it's going to be. We're not going to go back and try to true up the provisional rates to your actual rates at this point. And speaking of provisional rates, that's part 2 of this webinar series that will be held on February 20th. Not to give away, the whole series, but I think we've spoken about that before. So if that concept doesn't resonate with you, provisional rates, we'll talk about that in more depth in about a month's time.
Yes.
Okay, excellent. What about under the multiple tiered rate structure? Why do you start with fringe and occupancy instead of overhead and G&A?
And that is because of the order of indirect rates. And that was one of the things in the very end I tried to stress. So if, you may want to go back and look at it, is that the service centers must be computed first because then they're allocated to overhead and G&A. And Chris can tell you a quick story about that long backup detail to your indirect rates, and just how the computer person showed you how each of the different phases of a report. Remember you showed me earlier today, your brother?
Mm-hmm. And I'm sorry, I'm not following you.
Okay, so basically if you do a report and it's a software driven, you start with the fringe rate and the occupancy rate, if there is an occupancy rate, and then it's allocated to overhead and to G&A, and there's multiple phases in there. Okay, next question.
Okay, what's the advantage of using multipliers?
The advantage of using multipliers is very helpful in proposals.
Yeah, absolutely.
I mean, it is a way of gauging and determining how, what the true ultimate costs are, what your burden costs might be. But most importantly, even for a small entity, we want to know what the multiplier is so we can apply it to, the costs and so forth. But it's also important because there's certain people that want to try to drive the cost direct and get it as low as they can.
Exactly. Well, your multiplier is your true cost of doing business if you look at it that way. So once you know what your costs are, you can figure out what a fair and reasonable profit is over and above that.
Right. So
hitting a fee.
Yeah, and in fact, sometimes we'll do both. We'll do it all the indirect multipliers that get you up to the cost, and then we'll also maybe and figure out what that is, and then also do it with profit in, and like you say, figure out what you can afford.
Got it. Okay, excellent. I think we have time just for one more question. So let's say I'm a USAID contractor. Why am I sometimes audited by DCAA and other times I'm audited by a commercial auditing firm?
That's a very good question. In the past, it was DCA that was the exclusive auditor of many civilian agencies, but unfortunately they got backlogged in their incurred cost submissions, their settlement of their annual indirect rates. And because of that, particularly USAID that used DCA so much, and they reimbursed DCA for their time, that they were forced to put out an RFP and get some of these commercial private firms to do incurred cost audits. I will tell you this, if you don't like DCA, wait until you see these commercial firms because, DCA, in my opinion, does a much, much better job, and they are fair. There are certain rules. There's always a few issues here and there, but I would say long and short, DCA would try to be fair and let you give you the time to respond. Chris?
Yeah, I just wanted to add, what we have found is if a commercial firm does an audit, sometimes they come out of left field a little bit and they ask for things like, for example, they'll say to a prospective contractor when it comes to the concept of indirect rates, I want to see the indirect rates calculated out of your system. And as nice a feature as that is to have in your accounting system, there's no regulation that mandates that they have to calculate their rates within the accounting system. They can certainly download their general ledger trial balance and calculate their rates offline. But DCAA typically won't ding you on that. But a commercial firm, I've seen it where they've said, we want to see it coming out of the system. We want to see your billings coming out of the system. So in other words, they're trying to just challenge the integration aspects of your accounting system during the course of the audit. But again, there's nothing in the regs that say that you have to do it one way versus another.
Correct. Right. And I think even financial statement auditors too, they like to see everything out of the system. Once they see something apart from the system, right, there has to be some more audit tests.
That's right. Yeah.
Okay. Excellent. Well, with that, GRF would like to thank everyone for attending today's webinar. We always encourage you to check our website for upcoming events and updates at grfcpa.com/resources/webinars. And if you have any additional questions after today's webinar, please reach out to us. Our contact information was on a previous slide and it will be available. And again, just please remember to complete the emailed survey that follows if you'd like to earn CPE credit for today's webinar. And thank you once again for attending and have a wonderful day.